Chapter 10, Standard Costs and Variances. In business, you have standards or benchmarks that you have set in place to measure performance, to keep track of how you're doing, and to make sure that you have goals that you're constantly trying to reach and that you challenge the company. And we have dealt with this all semester long, and we just finished a chapter on budgets and flexible budgets and looking at the variances between the two. We looked at the variances between what we thought we would spend and what we did spend. We're going to take those same variances and look at them more in depth. If you have a variance of $500 with your raw materials, let's say it's a $500 unfavorable variance. It's hard to research where that unfavorable variance is coming from. In this chapter, we make it more clear. We have what's called price standards and quantity standards. That $500 unfavorable variance, is it because we paid more for the item than we thought? Or is it because we purchased more than we thought? By separating out that variance into price and quantity, we can find out exactly where the unfavorable portion comes from. We will look at the variances per unit because it matters how many units we produce and how much material we buy for those units to get the various standards that we're looking at and the variances in this chapter. We will do the same thing for direct labor. We will have the hourly rate and then also how many hours are required per unit. And of course, we have to include manufacturing overhead. And we will have a price standard and a quantity standard for the variable manufacturing overhead as well. This is the standard cost card, and we have the direct materials, direct labor, and the manufacturing overhead in here. We look at the standard quantity for each. For direct materials, we have a standard quantity of 3 pounds. The standard price is $4 per pound. And then we get a standard cost of $12 for direct materials for 1 unit. For direct labor, it takes 2.5 hours to make a unit. The standard price is $14 per hour, which comes to $35 in labor per unit. For manufacturing overhead, we have 2.5 hours at $3 an hour. The variable manufacturing overhead cost is $7.50. Then we can get our standard unit cost of $54.50. We're going to spend our time looking at the spending variances. We're going to look at the money that we're spending and deciding where exactly that variance is coming from. We'll first look at the general model for the variance and then look at more of an algebraic model that will give you the same answer. Now, when we do this, we're looking at the price and the quantity for all three: direct materials, direct labor, and overhead. For direct materials, let's say, it's the difference between the actual price we pay per item and then the standard price, which is the budgeted price that we allotted for that item. Our quantity variance is going to be how many did we purchase and how much should we have purchased for the amount that we made. One of the reasons why we look at the price and quantity standards separately is because if we have a favorable or unfavorable variance, it could come because we got the material cheaper or that we used more or less than we should have used. And the price of the material is going to be the purchasing manager, but how much we use is the production manager. So depending on what is the cause of the variance says which department you're going to go to for further investigation. Okay, here's the general model. And this first part, is your actual. It is your actual quantity at your actual price. How many did you actually purchase? And what was your actual cost? Then we're going to look at actual quantity at standard price. So in this one, we're looking at how many did we buy at the price we budgeted. So we'll take the price we budgeted at actual price, at actual quantity, times what we actually did pay for it, times how many we did. Take the difference between those two, and that gives us our price variance. Then coming over here for quantity variance, this right-hand side is our budget. This is what we budgeted. So we will take the standard quantity, which is how much we should purchase, and the standard price. So the standard quantity times the standard price. And then going back to the second one, we'll take our actual quantity, what we did purchase, at our budgeted price. So the actual quantity of materials we purchased at our budgeted amount allotted for that. Take the difference and you will get your quantity variance. Now the middle two are the same, and this is your flexible budget. If you take the difference between your price and your quantity variance, you do get your overall spending variance. But in actuality, we want to know the price variance and the quantity variance so we can find out what department we need to go to research the variance. Okay, let's now look at some direct material. Here we have an example of a company that makes parkas. And the fiber fill that's on the inside of the parka is, they use 0.1 kilograms of it for one parka, and that's at $5 per kilogram. Last month, they had 210 kilograms that were used to make 2,000 parkas. The cost of the 210 kilograms was $1,029. So what we're going to do is we're going to look at the amount of kilograms that they used, if it was more or less than they should have, and the cost of it. Is it more or less than it should have been? To obtain the price variance, we will take the actual quantity, which is the 210 kilograms, and look at how much we paid. We paid $1,029. If you divide those two numbers, you get what you paid per kilogram. The actual price we paid per kilogram is $4.90. But if you come over here, we budgeted $5. So with what we did actually use, 210 times our budgeted amount, we should have spent $1,050. We spent less than that. We have a $21 favorable variance. So we used, with the material that we used, we were able to get it for 10 cents, because that 10 cents is going to come back in the next slide. 10 cents cheaper. Favorable per kilogram. Okay. Now let's look at how much we used. We used 210 kilograms at the standard price of $5 is the $10.50, which we just looked at. The standard quantity for those 2,000 parkas we made, we should have only used 200 kilograms. At the standard price of $5 is 1,000. So we used 10 kilograms more than we should have, which ends up being a $50 unfavorable variance. We used 10 kilograms more. This is the algebraic way, using equations to figure out the same variances. Okay, if you remember, we had a $21 favorable materials price variance, and we had a $50 unfavorable materials quantity variance. What you can do is you can take the difference between your actual price and your standard price. Actual price was $4.90, standard price was $5. So here's that 10 cents I talked about. Take that 10 cents difference and multiply by how many you used, and you get your variance. You can do the same thing for the quantity. You can take your actual quantity that you used, which was 210, and subtract your standard quantity. You should have used 200. 210 that you used minus 200 that you should have used gives you 10 kilograms difference. And you multiply that by your standard price, which is $5, and that's where you get your $50 unfavorable variance. So these are two separate methods that you could use to calculate it, and it doesn't matter which one you use. Whichever one becomes easier for you. Okay, so who's responsible for the price variance? We've talked about that. The price variance is the purchasing manager. They're the ones that contract with the vendors and set the price, help set the price. Then who is responsible for the materials quantity? And we talked about that too. That's the production manager, because the production manager is the one that regulates the materials that come in and how much is used. If you have an unfavorable materials variance, you don't want to go to one manager and say, hey, this is your fault. You want to find out, is it the purchasing manager or is it the production manager? And then go to them and then find out. You investigate more. Why was more used? Why did we have a different price? And then you can further decide where you need to maybe make some changes and then move forward to help reduce your cost. Okay, looking at these material variances are not always controllable by one person or one department. The production manager can schedule the materials come in a way where the raw materials end up having an unfavorable variance. Maybe they waited too late to purchase the material, so they had to overnight the material over. And as you know, that adding shipping charges and delivery charges are added to the cost of the material. So it could be that the price increased because the production manager overlooked the time and purchased too late. Or it could be that the company was out, the vendor was out of that material, so they had to go to another vendor and that vendor charged more. Looking at the production manager, they may have had to use more because inferior product was ordered. Maybe the purchasing manager found a deal with another company to get it 10 cents cheaper, but the material was not as good of a quality. And when the workers made the product, they had to scrap a lot of it because it was inferior quality, which means they ended up using more material than necessary. So it's not a cut and dry reason, but it's a good place to start. Okay. Hansen Inc. makes a zippy. And they use 1.5 pounds of material per zippy, and that material is at $4 per pound. Okay, so they need 1.5 pounds, and it's $4 per pound. Last week, they used 1,700 pounds of material to make 1,000 zippies. The cost of that 1,700 pounds of material was $6,630. Okay, we're going to do an analysis on them and check to see where they were at. You need 1.5 pounds and you made 1,000. So you should have used 1,500 pounds. So this is your standard quantity. Should have been 1,500 pounds. The equation for the materials quantity variance is you take the difference between your actual quantity of 1,700 pounds and you subtract your standard quantity of 1,500 pounds. You get 200 pounds. Multiply that by the standard price of $4 per pound, and you come up with an $800 unfavorable variance. They used 200 more pounds than they should have used for the amount that they bought. The amount that they made. Okay, let's look at the price. The actual price was $3.90. The standard price was $4. So there's a 10 cents difference in their favor. Multiply by how many pounds they actually did use, and they're $170 favorable because they saved 10 cents. Their price variance is favorable, but yet the quantity variance is unfavorable. And this is pretty common. Both of the examples that we've looked at has a favorable price variance, but an unfavorable quantity variance. The first thing that you'd want to check when you have this is look at, why is the price cheaper? Was it from a different company? Was it from a different batch? Because maybe they used more because the material was inferior. That would be the first thing you'd want to look at. Okay, let's look at a practice problem. Okay, Woodson Wood Products manufactures various items of wood. One of these products is a chair. Okay, they manufactured 1,700 chairs, and they used 8,205 board feet of hardwood. That cost the company $32,000, and the standard for one chair is 5 board feet of hardwood at $3.85 per board. Okay, the first question that we want to answer is, what is the standard quantity of board feet of hardwood that is allowed for 1,700 chairs? The number of chairs that they made were 1,700. They should have used 5 feet per chair, which is a total of 8,500 board feet. The board cost $3.85 per board feet, which would have cost $32,725. Okay, to get the variance, the cost they incurred, they spent $32,000. Using their standard cost that they calculated, it should have been $32,725, which is a favorable variance of $725. Okay, the materials price variance. Take the 8,205 board feet that they did use and multiply it by the difference between what they paid for it and what the standard price was for it. They actually ended up paying $3.90 per board foot, and what they budgeted for was $3.85. So they spent 5 cents per board foot more. Multiply that 5 cents by the 8205 board feet that they used, and you get an unfavorable variance of $410. You'd think that 5 cents doesn't make a difference, but when you're buying in bulk like this, it adds up very quickly. Okay, let's look at the quantity. The actual quantity they used was 8205. The standard or the budgeted that they should have used for that amount is 8500. Multiply the difference between that by the cost per board foot, and you get a favorable variance of 1135. So they used less than they should have, or they used less board feet than what was budgeted. And then on the price variance, they spent more on it than what they budgeted. So this is exactly in reverse. Maybe they chose to spend 5 cents more to get a higher quality hardwood, so they were able to use less wood in their product. Okay, so we just did an example of materials price and materials quantity variance. Looking at the direct labor and the manufacturing overhead works the exact same way. Same formulas, same everything. The only difference is instead of dealing with the cost of the material, it's the labor rate. Instead of dealing with how many pounds or yards of material you used, you're looking at how many hours did you take. Other than that, it's the exact same process. Okay, let's go back to the Glacier Peak Outfitters that makes the parka. It takes 1.2 standard hours to make a parka, and the average rate of pay is $10 an hour. The employees worked 2,500 hours, and that cost the company $26,250 to make those 2,000 parkas we talked about earlier. We're still looking at the rate variance and the efficiency variance, which is the same thing as the price and the quantity variance. Take your actual hours of 2,500 and divide that by the total cost, and that gives you $10.50 per hour. So they actually spent $26.25. With using 2,500 hours at the at the standard rate of $10 an hour, they should have only have spent $25,000. So they have a $1,250 unfavorable variance. Okay, looking at the efficiency variance, take their actual hours of 2,500 times the $10, which was their standard, and you got the 25,000. They only used 2,400. Oh no, they used 2,500. The amount of hours that they budgeted was 2,400 and at $10 an hour, which is 24,000. They have a $1,000 unfavorable variance. One, they used 100 more hours. And then actually two, they were at 50 cents an hour more. So both their rate and their efficiency variance are unfavorable. Here's the algebraic equation way to get the same thing. The labor rate variance, take what you did pay them, $10.50, minus what was budgeted, $10. That's a 50-cent difference. Take that difference and multiply it by how many hours were used, and that's where you get your unfavorable variance. For the labor efficiency variance, you can also take how many hours you used and subtract how many hours you should have used, and that is 100 hours. Multiply that by your budgeted per hour amount, and that's where you get your favorable or your unfavorable, in this case, labor efficiency variance. The production managers are usually held responsible for any of the labor variances. because they have so much control over it. One, they can choose the right mix of skill levels and assign the work tasks accordingly. They're responsible for employee motivation and for the quality of supervision. They also train their employees and choose who is going to do the training. So they do have most of the influence on any variance in labor. However, this is an example of when any variance with the labor could be from another department. Maybe the maintenance department did a poor job maintaining the equipment, which then broke down often or didn't work right, and it took longer to make the products, which means more labor hours. Or that the purchasing manager purchased lower quality material, which also ended up taking more time to complete, hence a higher labor variance. Okay, looking back at Zippy, it takes an hour and a half to make their product, and their rate of pay is $12 an hour. Last week, they used 1,550 direct labor hours for a total cost of $18,910, and they made 1,000 Zippies. Their labor rate variance, the actual rate is $12.20. The standard rate that they budgeted for was $12. Multiply that by how many hours they actually paid them for, that they used, and you get your $310 unfavorable variance. I'm looking at their efficiency variance. Their actual hours of 1,550 minus the budgeted hours of 1,500. So they used 50 hours more than what was budgeted. Multiply that by the standard rate of $12, and that's $600 unfavorable. This is the general model. You get the same answer, a rate variance of 310 unfavorable, and an efficiency variance unfavorable of $600. So you can do this either way and you should get the same problem. Okay, let's look at another problem. We have this company called To Go or Togo Meals. They prepare pre-packaged meals for busy commuters to grab and go. And one of the items that they wanted to look at was a BLT on oat wheat bread with honey Dijon mustard. They prepared 8,000 of these meals. They used 2,480 direct labor hours. The total cost of the direct labor was $24,180, and they pay their employees $9.75 an hour. It should take 0.3 direct labor hours at a cost of $10 an hour to do this. Let's look at the standard labor hours that were allowed to prepare these 8,000 meals. They prepared 8,000, takes 0.3 hours to make the meal, so they should have used 2,400 hours. Take those 2,400 hours that they used and multiply it by the standard hourly rate of $10, and you get 24,000. The actual cost incurred was 24,180. What they should have used was 24,000. So they have an unfavorable spending variance of $180. Oops. Okay. Their labor rate variance. Take the actual rate of $9.75 and subtract the $10 per hour. So you get a difference of 25 cents. Multiply that 25 cents favorable by the actual hours, and you get $620 favorable. For the labor efficiency variance, take the actual hours that they used, which is 2480, and then subtract the hours that they should have used, which is 2400. You have a difference of 80 hours. Multiply that by the standard rate of $10, and you get an unfavorable variance of $10. Okay, now let's move on to variable manufacturing overhead. Again, it takes 1.2 standard labor hours at $4 per labor hour. And this time, the employees worked 2,500 labor hours to make 2,000 parkas. The cost of that is the actual variable manufacturing overhead cost for the month is $10,500. Using the general model, take your actual hours times their rate, and you get 10,500. Then take their actual hours times the standard rate of $4 per hour for variable overhead, and you get 10,000. They have a $500 unfavorable variance because they ended up spending $4.20 per labor hour for their variable manufacturing overhead. Take that same actual hours of 25 times the standard rate and compare it with the budget. The budget was 2,400 hours, 100 hours less, at $4 per hour, and you get $9,600. Your efficiency variance in this case is $400 unfavorable. So you have an overall manufacturing overhead variance of $900. You can get the same answers using the equations. Take the difference between your actual hour rate and your standard hour rate and multiply it by your actual hours. The 20 cents difference times your actual hours, and that's where you get your $500 unfavorable variance. Oops, I went backwards, sorry. Okay, your efficiency variance, same thing. Take your standard hours of 2,500, subtract the hours you used, 2,400. Nope, I said that backwards. Take your actual hours of 2,500, subtract your standard of 2,400, which is 100 hours difference, and it is 100 hours unfavorable, and multiply it by the standard rate of $4 per hour, and you have an unfavorable variance of $400. So I showed you both ways of how to calculate it where you get the same answer. Okay. Hansen Inc., who makes the Zippy, uses 1.5 standard labor hours at a variable overhead rate of $3 per direct labor hour. This week, they used 1,550 labor hours to make 1,000 Zippies, and the actual variable manufacturing overhead that was spent was $5,115. First thing that we're going to look at is the variable manufacturing rate variance. Their actual rate was $3.30. The standard rate that was used or calculated was $3. They spent 30 cents more per labor hour on variable manufacturing overhead. Multiply that by the actual hours they used, and that's where you get your unfavorable manufacturing overhead, variable manufacturing overhead rate variance of $465, unfavorable. Okay, now let's look at the efficiency variance. For the efficiency variance, you're going to take the actual hours minus the standard hours. The actual hours, you have 50 more, and then by the 1.5, and then multiply that by $3, and you get 150 unfavorable. This is the same problem, but this one is the general model. Your actual hours your actual hours times your rate, and then you compare that to your actual hours times what you budgeted, and that's where you get your unfavorable variance. Okay, let's practice a problem. Okay, here we have a company, and in the most recent month, they made 72,000 items using 6,900 direct labor hours. That cost $21,390. Their standards is 0.1 direct labor hours to fulfill the item, and a variable overhead rate of $3 per direct labor hour. Okay, let's first calculate the standard labor hours. They shipped 72,000 items, and it's at 0.1 hour. That is 7,200 hours that are allowed for this project. The direct labor hours allowed was 7,200. The variable overhead cost per hour that was calculated using a predetermined manufacturing overhead rate was $3, which is $21,600 for a total standard variable overhead cost. The overhead spending variance, take the $21,390, which is what actually incurred, subtract the standard that was allowed, and they end up having a $210 favorable variance. The overhead variance, the $3.10, which was the actual rate, minus the $3, which was the standard rate that they calculated, is 10 cents. Multiply that by the actual hours used, and you have an unfavorable variance of $690. Then for the overhead efficiency variance, they actually had 6,900 hours. What was budgeted was 7,200, which is good. They used less hours, and that's at $3 per hour. So with that is a $700 favorable variance. Okay, just remember that the quantity variance is computed only on the quantity used. The price variance is computed on the entire quantity purchased. Okay, this is the end of Chapter 10, Standard Costs.